Have you ever seen someone post their grid trading profits, small wins stacking up like a steady paycheck, and thought, I can do that? So you set up a grid, and within days the market takes off. Your grid not only fails to profit, but you sell your position at the bottom or buy a pile of losing trades at the top. What went wrong? It's not that grid strategy doesn't work. It's that you didn't understand the 3 types of grids, and you used the wrong one for the market. Today, I'm going to share the hard-earned lessons from years of trading grids, how to set up your net, how to manage it, and how to escape when it breaks. By the end, you'll see that a grid is not a passive tool for beginners. It's a precision machine that needs careful tuning. Before you start placing orders, you need to understand the fundamental logic of a grid. Think of it as setting a fishing net in a water area where fish are known to gather. The size of your net, the density of the mesh, and how deep you place it determine whether you catch fish or get torn apart by a shark. Grid trading has 3 core elements. First, the upper and lower boundaries of the range, which decide where you place your net. Second, the grid spacing, or the interval between each order. If the mesh is too tight, you trade frequently but each profit is thin. If it's too wide, you trade less and might miss moves. Third, how many layers your capital can support, which determines how much water pressure your net can withstand. But all of this hinges on a critical assumption: the market must keep oscillating. When volatility suddenly expands, like a fast current, your net gets swept away. So I use the recent average of ATR, or average true range, as a warning line. If volatility exceeds 1.5 times that average, I stop opening new positions and first check whether the range still holds. There are 3 main types of grids. The first is the static grid, which beginners love. You pick a sideways range, place sell orders at the top and buy orders at the bottom, set a few equal-spaced layers in between, and let it run. This works well for markets that move like an electrocardiogram, staying flat for months. But the problem is you can't know in advance how long the sideways move will last. Many people set up their grid just before a breakout, and then they don't know what to do. They don't stop out, hoping the price will come back. That's the biggest trap of static grids. They are simple to use, but the hardest to manage when the range breaks. The third type is the Martingale grid, and I have to call it out separately because it's a source of losses. The logic sounds tempting: the more the price drops, the more you buy, and the more you buy, so when the price bounces even a little, you can exit with a profit. Many grid bots use this logic by default. But it's a mathematical trap. Suppose you start with 1 unit, and every 2% drop you double your position. After 10 drops, your position is 512 times your initial size, while the price has only fallen 20%. If it keeps dropping, your equity curve collapses. Worse, during a sideways market, you'll book dozens of small wins, building false confidence, and then a single trend takes you to zero. My strong advice: beginners should never touch any grid with Martingale logic. It's slow poison. This chart shows the equity curves of 3 grid types during the same one-way declining market, based on a simulation. The equal position and dynamic grids are also losing money, but their losses are linear and controllable, and they exit when they hit their stop loss. The Martingale grid, on the other hand, looks stable at first, even slightly profitable, but when the market doesn't reverse, it drops from 40,000 to 5,000 in the 6th week. That's the terror of Martingale: it doesn't lose slowly, it dies suddenly. Many people get lulled by consecutive small wins, and then a single trend takes away all profits and even the principal. So your choice of grid type directly determines the lifespan of your account. Now let's get practical: how to build a safe grid. Step 1. Define the range. I refuse to trade short-term sideways moves. I only pick instruments that have been flat for at least 3 months, and I use the 90-day high and low as the range boundaries. Step 2. Determine the grid spacing. Don't guess. Use ATR. For example, if the recent average ATR is 2%, I set my grid spacing between 1% and 2%, ensuring each order triggers on a meaningful move, not noise. Step 3. Calculate the number of layers and capital. Divide the total range by the spacing to get the number of layers. Then make sure your total capital can cover all layers, and each layer's position is no more than 5% of your total capital. Step 4, and this is the most critical, set a hard stop loss. Beyond the range boundaries, add a buffer of 1 to 2 times the grid spacing. If the price breaks through the buffer, I don't wait for it to come back. I close everything. Then I switch roles from a grid trader to a trend observer, evaluating whether to open a trend trade. This chart reveals a counterintuitive conclusion. Grid strategies perform best in medium volatility environments, while they actually lose money in high volatility. Why? Because high volatility often signals a trend start or a range breakdown. Grids in high volatility trigger stop losses frequently, causing excessive wear and tear. Low volatility is safe, but profits are too thin to cover transaction costs. So the best soil for grids is a market with moderate volatility and a clear range. I now assess volatility weekly. If I see volatility rising from low to high and breaking a threshold, I proactively tighten the grid or even pause trading. Finally, let's discuss the 4 most common fatal mistakes in grid trading. Each one is a lesson I or people around me learned painfully. First, refusing to admit you're wrong. The price clearly breaks the range, but you comfort yourself by saying, it will come back. 80% of grid losses come from this mindset. Remember, once the range boundary is effectively broken, it becomes the start of a new trend, and your net is useless. Second, manual intervention. Many people, while the grid is running, decide to buy more at a certain level or skip an order because they think the market is off. This completely destroys the probability advantage of the grid. You're fighting against your own strategy. Third, reinvesting profits. During a sideways period, you make small wins consistently, feel good, and add more layers with the profits. This is essentially adding leverage, and when the market turns, losses accelerate. Fourth, using the wrong instrument. Strong trend stocks, highly volatile cryptocurrencies, and event-driven assets are not suitable for grids. Grids love those boring, stable volatility broad indices or low volatility commodities. Choosing the right instrument is half the battle. Now, let's formalize the grid spacing calculation. The grid spacing is set as a multiple of the average true range, or ATR, which measures how much an asset typically moves over a given period. A common practice is to set the spacing between 0.5 and 1.0 times the ATR. This ensures your orders are placed at meaningful price levels, not just noise. To validate this, you would observe the ATR for your instrument, set your multiplier, and then test it. If your grid trades too frequently and generates many small losses, you might increase the multiplier. If it trades too rarely and misses profitable moves, you might decrease it. The key is that the spacing adapts to volatility, so it remains effective across different market conditions. Let's look at the math behind the Martingale trap. The position size at each layer doubles, so after n drops, your exposure is the initial position times 2 to the power of n-1. This exponential growth means that after 10 drops, your position is 512 times your initial size. The danger is that the market can keep dropping far longer than you expect. To validate this risk, you can calculate how many consecutive drops would be needed to wipe out your account. If that number is small, say 5 or 6, the strategy is extremely risky. The only way to falsify this is to find a Martingale grid that survives a prolonged trend, which is rare and usually depends on an unlimited capital assumption. Another important formula is the number of grid layers. You take the difference between the upper and lower boundaries and divide it by your grid spacing. This tells you how many orders you can place within the range. This number directly impacts your capital requirements. If you have a wide range and tight spacing, you'll need many layers, which means more capital. To validate this, you define your range, calculate the layers, and then check if your account can support all of them. If not, you need to widen the spacing or narrow the range. If your grid runs out of funds before the range is covered, that's a clear sign your parameters are misaligned. Grid trading is essentially time arbitrage in a sideways market. You're harvesting the market's indecision. There are 3 grid types: static is simple but rigid, dynamic is flexible but complex, and Martingale is a death trap, never touch it. Build a grid in 4 steps: set the range, calculate spacing, allocate capital, and set a hard stop loss. If the grid breaks, exit immediately. Avoid 4 fatal mistakes: not stopping out, manual intervention, reinvesting profits into more layers, and using the wrong instrument. When the market is hesitant, you harvest mechanically. When the market is decisive, you must be even more decisive. That's the right way to use a grid. Today we covered the 3 grid types, the 4-step building process, and the 4 fatal mistakes. You don't need to jump into live trading right away. Instead, do this: open your charting software, find 3 instruments that have been sideways for over 3 months, and using the method I described, calculate the range boundaries, ATR-based spacing, number of layers, and buffer stop loss. Write them down. Then compare them against the past year of price action to see where your grid would have made money and where it would have broken. After you've done that, tell me in the comments which instruments you chose and what parameters you set. I'll pick a few to review. See you in the next one. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.